Gold and silver warning. $125 billion in Treasury debt. Drops. This week, 3 auctions, 1 week, and a number that Washington does not want you watching. $125 billion in government debt is about to hit the market in a matter of days. Not next month, not next quarter, this week. And if the demand for that debt comes in weak, the ripple will not stay in Washington. It will move through gold, through silver, through the dollar in your wallet. Somewhere on the other side of the world, a central bank is already running out of options. And what happens there may decide what happens to your savings here. Stay with this video until the end, because the last number we reveal is the one nobody else is talking about. Welcome back to Precious Metals Intelligence. If you're new here, this channel exists for one reason: to translate complex, fast-moving economic developments into clear, strategic insight, without the noise and without the hype. Before we go further, we genuinely love to know where in the world you're watching from today. Drop it in the comments below, and if you find value in this kind of grounded, no-nonsense analysis, consider joining the community by subscribing. It helps this channel continue doing the research, so you don't have to. This week, the United States government will ask the world for a very large favor. It will ask investors to lend it $125 billion in just 3 days. Most people will never hear about this. Most news channels will not lead with this story. But for anyone who owns gold, silver, stocks, or even a savings account, this is the number that matters most right now. Here is what is actually happening. The U.S. Treasury sells debt every week to pay the government's bills. This is normal. It happens constantly. But this week is different. 3 separate auctions are landing back to back: short-term notes, medium-term notes, and long-term bonds. Altogether, they add up to $125 billion of new debt hitting the market in a single week. Why does this matter to someone who has never bought a government bond in their life? Because these auctions are a test, not a test of the economy, a test of confidence. Every time the Treasury holds an auction, it is really asking a simple question to investors around the world: do you still trust us enough to lend us money at this price? If the answer is yes, the auction goes smoothly. Buyers show up, demand is strong, interest rates stay where they are expected to stay. Life goes on. But if the answer is no, or even a hesitant maybe, something changes. Buyers demand a higher return to take the risk. That pushes interest rates up. And when interest rates rise unexpectedly, it does not stay contained in the bond market. It spreads. It touches mortgages, it touches business loans, it touches the stock market, and it touches gold and silver, often before most people even notice something is wrong. This week, almost everyone's attention will be pointed somewhere else. On Wednesday, the government releases its monthly inflation report, known as the Consumer Price Index. This report gets enormous attention. Cable news will cover it. Financial analysts will debate it for hours. Traders will react to it within seconds of its release. But here is the problem. Inflation data tells us what already happened last month. It looks backward. The Treasury auctions this week tell us something far more important. They tell us what investors think about the future. They reveal whether the world still wants to finance American debt at current interest rates, or whether that appetite is starting to fade. This distinction rarely gets explained clearly, and that is exactly why it deserves attention now. A weak inflation report might cause a short burst of excitement in the markets. But if that excitement is followed by a poor auction result, the celebration will not last. The market would be sending a clear message: relief on inflation is not enough. Investors want more compensation to hold U.S. debt, whether because of inflation risk, government spending, or simple uncertainty about the future. This is where gold and silver enter the story. Precious metals do not just react to what already happened. They react to trust. When investors start to doubt a government's ability to manage its debt responsibly, gold tends to rise first. It is often called a safe haven for exactly this reason. Silver behaves a little differently. It carries some of that same safe haven demand, but it is also tied to industrial activity and economic growth. This makes silver more sensitive, more volatile, and in some ways more revealing about what investors truly expect next. So this week is not simply about one inflation report. It is about a much bigger and quieter question. Can the United States continue borrowing hundreds of billions of dollars every single week without facing resistance from the very investors it depends on? For decades, the answer has almost always been yes. The United States has enjoyed a kind of financial trust that few other countries in the world have ever had. But trust is not permanent. It can weaken slowly, almost silently, long before headlines start using words like crisis. And this week, the first real signs of that shift may not come from Washington at all. They may come from the other side of the world, from a country already struggling to control its own currency and its own bond market. What happens there in the coming days could quietly decide what happens to the value of the dollar, the price of gold, and the price of silver here at home. That story begins on the next page of this analysis. Halfway around the world, a much quieter drama has been building for months, and it may end up shaping what happens to gold and silver far more than anything said in Washington this week. The country at the center of this story is Japan. For decades, Japan kept its interest rates close to zero. Its banks, its pension funds, its entire financial system was built around the idea that borrowing money would always stay cheap. That assumption worked for a long time, but it is no longer holding. Japan's currency, the yen, has weakened significantly. At the same time, yields on Japanese government bonds have started climbing, slowly at first, then with more urgency. And the government still wants to keep borrowing costs low enough to support its economy. These three goals, a stable currency, low bond yields, and cheap borrowing, cannot all be achieved at once. Economists sometimes call this an impossible trilemma. A country can manage two of these goals at a time, but rarely all three together. This is not just an abstract theory. It creates real difficult choices for Japan's central bank. If it raises interest rates aggressively to defend the yen, it risks shaking its own bond market and unwinding years of cheap borrowing that investors around the world have relied on. If it buys more of its own bonds to keep yields low, it creates more currency in the system, which weakens the yen even further. And if it sells foreign assets to raise cash and support the yen, a large share of what it would sell is United States government debt. This last point is where the story connects directly back to America. Japan is one of the largest foreign holders of U.S. treasuries in the world. If Japan ever needed to sell a significant portion of those holdings quickly, it would add new supply into an American bond market that is already absorbing $125 billion of fresh debt this week alone. More supply, combined with already stretched demand, tends to push interest rates higher, not lower. There is a specific number worth watching closely here. Japan's 10-year government bond yield is sitting near 2.8%. To an American investor accustomed to yields closer to 5%, that number might sound small and unremarkable. But for Japan, it is historic. The entire structure of Japanese banking, insurance, and retirement savings was built around a world where borrowing costs stayed near zero for decades. A yield near 3% is not a minor shift for that system. It is a significant stress test. Former officials from Japan's central bank have said publicly that yields somewhere between 3 and 3.5% begin to raise serious questions about the country's long-term financial stability. Right now, the market is not far from that threshold at all. This is not a distant or isolated issue. The United States and Japan have already worked together in recent weeks to help stabilize the yen. On the surface, that kind of cooperation looks like a normal, routine effort between allies. But look closer, and a second motive becomes clear. Washington has just as much interest in preventing Japan's currency troubles from spilling into the American bond market as Japan does in protecting its own currency. If Japan were forced to dump U.S. treasuries suddenly to defend the yen, it would not just be Japan's problem. It would become America's problem too, arriving at the exact same moment the U.S. Treasury is already asking the world to absorb $125 billion of new debt. This is why professional investors are not only watching the inflation report or the auction results this week, they are also watching Tokyo. A currency crisis on one side of the world can very quietly become an interest rate problem on the other side. And by the time it becomes obvious, the movement in gold and silver has usually already begun. For everyday investors, this may feel disconnected from daily life. Japan's bond market probably was not on anyone's radar before this week, but financial markets are more connected than most people realize. A stress point in Tokyo can influence borrowing costs in the United States within days, not years. And when borrowing costs shift unexpectedly, precious metals are often among the first assets to respond, long before it becomes a headline story. So while most of the attention this week will stay focused on inflation numbers and interest rate speculation, the more important signal may be coming from a bond market most Americans have never even looked at. What happens next depends on how this week's Treasury auctions actually perform, and that story comes next. When the Treasury sells debt this week, most people will only see one headline number, whether the auction happened or not. But professional investors look much deeper than that. They study three specific signals, and each one tells a different part of the story about how much the world still trusts American debt. The first signal is called the tail. This sounds technical, but the idea is simple. Before an auction happens, traders already have an expectation of what interest rate or yield the bonds should sell at. If the auction closes at a higher yield than expected, that gap is called a tail. A small tail is normal and nothing to worry about. A large tail is a warning sign. It means buyers were not satisfied with the expected return, and they demanded more compensation before agreeing to lend the government money. In simple terms, a large tail means the government had to pay more to convince people to buy its debt. The second signal is who actually buys the debt. Auction buyers are grouped into different categories, and one of the most watched groups is called indirect bidders. This category includes foreign governments, foreign central banks, and large international institutions. When this group buys a strong share of an auction, it signals that global confidence in America's financial system remains solid. But when their participation drops, it raises a quiet but serious question. Are international buyers starting to pull back from U.S. debt, even slightly? The third signal involves primary dealers. These are large financial institutions that are required to participate in every Treasury auction, almost like a built-in safety net. In a healthy auction, dealers only absorb a small portion of the debt because outside investors are eager to buy most of it themselves. But when demand from everyday investors and institutions is weak, dealers are forced to take on a much larger share than usual. This is not a sign of strength. It is a sign that real demand fell short, and someone had to step in to fill the gap. Together, these three signals, the tail, the indirect bidder share, and the primary dealer share, tell investors whether this week's $125 billion in debt was absorbed with confidence or absorbed with difficulty. Now picture two very different outcomes. In the first outcome, inflation data released this week comes in soft, meaning prices are rising more slowly than expected. At first, this excites the market. Stocks rise. Gold and silver both move higher. But then the actual auction results come in and they are weak. The tail is large. Indirect bidder demand is disappointing. Primary dealers are stuck holding more debt than they wanted. This combination sends an important message. Investors are not just reacting to inflation anymore. They're also demanding more compensation for holding U.S. debt long term, whether because of concerns about government spending, future inflation, or simple uncertainty. In this scenario, gold tends to benefit the most because gold thrives when confidence in monetary policy and government finances weakens. In the second outcome, inflation data comes in soft and the auctions go smoothly. Indirect bidders show up in strong numbers. Primary dealers are left holding very little. This is the cleanest, calmest outcome possible. In this case, both gold and silver tend to perform well, but silver often has more room to move because silver depends on more than just fear. It also depends on stable financial markets and steady economic activity. This leads to one of the most important distinctions in this entire story. Gold and silver are not identical assets, even though they often move in the same direction. Gold is primarily a monetary metal. Investors turn to it when they lose confidence in currencies, central banks, or government finances. It performs well during moments of fear and uncertainty, almost regardless of what is happening in the broader economy. Silver is different. It carries some of that same safe haven demand, but it is also deeply connected to industrial use in electronics, solar energy, and manufacturing. This means silver needs two things to perform strongly at the same time: a loss of confidence in paper currencies and a reasonably healthy economy that keeps industrial demand alive. When financial markets become unstable very suddenly, silver can actually fall sharply, even while gold rises, because sudden panic often hurts industrial demand and forces investors to sell whatever assets are easiest to sell quickly. This is why serious investors do not view gold and silver as identical trades. They view them as two different signals measuring two different kinds of stress, one measuring trust in money itself, and the other measuring trust in the broader economy. But there is something else adding weight to this week's developments, something rooted not in numbers, but in history. And that story is where the analysis turns next. Beyond this week's auctions and beyond the situation unfolding in Japan, there is a much larger and slower moving story that adds weight to everything happening right now. That story is the size of America's total debt and how the government actually accounts for the gold it holds. The gross national debt of the United States is now approaching $40 trillion. This number is so large that it becomes difficult to picture in any meaningful way. But the direction matters more than the exact figure. Debt has not been shrinking. It has been climbing steadily year after year, regardless of which political party controls Washington. And as debt grows larger, the government's choices become more limited. Every decision now comes with a trade-off somewhere else. Lower interest rates might ease borrowing costs, but they can weaken the currency further. Higher interest rates might support the currency, but they make the existing debt far more expensive to manage. There is no longer a simple, cost-free path forward. This growing pressure connects directly to a story that received fresh attention recently when a United States senator visited Fort Knox, the famous facility where a large portion of America's gold reserves are stored. The senator was shown the gold held inside, though it was not a full independent audit. Fort Knox reportedly holds around 147 million ounces of gold, which is a little more than half of the government's total gold reserves. At today's market prices, the gold stored there alone would be worth well over $600 billion. Yet officially, the government still values that gold on its books at around $42 per ounce, a price that has not changed in decades and no longer reflects reality in any way. This creates an unusual contradiction. The same gold that the government protects with extreme military-level security is simultaneously listed on official records at less than 1% of what it is actually worth in the market today. Governments do not spend enormous resources guarding something they consider worthless. The security itself tells its own story, separate from any official number on a balance sheet. The senator's larger concern extended beyond the gold itself. He pointed out that the US dollar has lost more than 85% of its purchasing power since 1971, the year the United States fully ended the direct link between the dollar and gold. In simple terms, something that cost $1 in 1971 would cost several times that amount today, not because the item became more valuable, but because the dollar itself became weaker over time. This is the quiet, long-term backdrop behind everything happening this week. It is not only about one inflation report or one set of Treasury auctions. It is about a currency that has been gradually losing strength for more than 50 years, attached to a level of government debt that continues to grow without any clear plan to slow it down. There is one more piece completing this picture, and that is energy. Oil prices have been climbing, driven partly by ongoing tensions in major oil-producing regions. Higher energy costs tend to feed directly into inflation because energy touches nearly every part of the economy, from transportation to manufacturing to everyday household expenses. If energy prices remain elevated at the same time the job market begins to slow, it creates a difficult combination: slower economic growth paired with persistent inflation. This is not the gentle, controlled outcome that markets hope for. It is a much harder environment for policymakers to manage carefully. Every piece discussed so far, this week's Treasury auctions, the pressure building in Japan, the growing national debt, and the true value of America's gold reserves, none of these exist in isolation. They are connected, and together they form a much larger picture than any single headline can capture. The final question is what all of this means for the days directly ahead, and which numbers actually deserve the closest attention going forward.